While everyone's chasing the Florida dream for zero state taxes and endless sunshine, they're walking straight into the biggest wealth trap of the decade. And I can prove it with numbers. Right now, a family that bought a home in Tampa in 2021 for $400,000 isn't celebrating their equity gains. They're drowning. Their home insurance just jumped from $1,800 a year to $12,000. Their property taxes tripled because they don't have the homestead exemption locked in like the locals. And they're watching their neighbors list their homes with price cuts every single week. They're trapped, and they're not alone. This isn't some doomer prediction. This isn't clickbait. The Florida housing market is facing a perfect storm that will absolutely create the next generation of millionaires while simultaneously destroying the retirement plans of people who thought they were making a smart move. And by the end of this video, you're going to know exactly which side of that equation you want to be on. I'm Finance Ferret, and I don't do hopium. I do data. Let's get into it. Florida has four massive problems converging at exactly the same time. I call them the four horsemen of Florida's housing apocalypse. And unlike 2008, there's no government bailout coming to save this. Horseman number one, the insurance crisis. 15 major insurance companies have completely fled Florida in the last 3 years. Gone. State Farm, Farmers, AAA. They looked at the numbers and said, we're out. What's left? Citizens Property Insurance, which is the state-backed insurer of last resort, and it's completely overwhelmed. They're carrying over 1.3 million policies right now. They were designed to handle a fraction of that. Homeowners are facing annual premiums of $10,000 to $15,000. The national average is $2,000. Let that sink in. You're paying an extra $1,000 a month just to insure a house in Florida, compared to almost anywhere else in America. And it gets worse. These aren't temporary increases. Insurance companies aren't coming back. They've run the actuarial tables, they've seen the hurricane data, they know what's coming. Which brings us to horseman number two, climate reality. Hurricane Ian caused $112 billion in damage. That's not a typo. One storm, $112 billion. But here's what nobody wants to talk about. Ian wasn't a black swan event, it's the new normal. Sea levels are rising. FEMA is redrawing flood maps. Properties that weren't in flood zones 5 years ago are now high risk. And if you're in a high-risk flood zone, good luck getting affordable insurance. Actually, scratch that. Good luck getting insurance at all. Coastal properties that were considered prime real estate are being systematically repriced by reality, and that repricing is permanent. Horseman number three, the property tax bomb. Here's the dirty secret about Florida taxes that all the influencers moving to Miami conveniently forget to mention. Yes, there's no state income tax. Congratulations. But property taxes in Florida are brutal, especially if you're a new buyer. The homestead exemption caps annual increases at 3% for existing owners. But if you just bought, you're paying full freight based on current valuations. Your neighbor who bought in 2015 might be paying $3,000 a year. You just bought the identical house next door. You're paying $9,000. And municipalities across Florida are facing massive budget shortfalls. They're raising rates. They have to. Someone's got to pay for all that hurricane infrastructure repair. Horseman number four, the oversupply tsunami. From 2021 to 2023, Florida went on the biggest building spree in state history. Developers saw everyone moving in, and they built and built and built. Miami has a condo construction glut that would make Dubai blush. Tampa, Orlando, Jacksonville, cranes everywhere. But here's the problem. Over 30% of Florida properties are investor-owned. These aren't people's primary homes. These are Airbnbs. These are rental properties. These are speculative investments. And when the math stops working, when insurance and taxes eat all the rental income, investors don't have emotional attachment. They dump. We're already seeing it happen. Days on market are up 40% year over year. Inventory has surged 80% from 2023 lows. Price reductions are cascading through luxury markets in Naples and Miami Beach. The pending sales numbers for Q4 2024 fell off a cliff. This isn't speculation. This is data. This is happening right now. Let's talk affordability because the numbers are absolutely insane. The median home price in Florida is $420,000. To afford that, you need a household income of about $130,000 using traditional lending standards. The median household income in Florida, $67,000. Do that math. The median earner in Florida cannot afford the median home in Florida. Not even close. But wait, it gets better. That $130,000 income requirement assumes normal insurance and property taxes. Factor in the real costs, the $10,000 insurance premium, the actual property tax bill, and your total monthly housing cost is $3,500. You need to be making $150,000 a year, minimum, to comfortably afford a median-priced home in Florida. This is not sustainable. This is not a healthy market. This is a bubble running on fumes, and the migration data is starting to reflect reality. U-Haul pricing, which is pure supply and demand, is flipping. It used to be expensive to rent a truck to Florida and cheap to rent one leaving. That spread is collapsing. In some markets, it's reversing. Domestic migration into Florida is slowing dramatically. The COVID remote work boom that fueled this, companies are mandating return to office. That arbitrage is closing. People are doing the math, and the math doesn't work anymore. Now here's why this crash is going to be different from 2008 and why that matters for how you respond to it. 2008 was a lending crisis. Banks gave mortgages to anyone with a pulse. When people couldn't pay, the whole system collapsed. This is not that. This is a cost of ownership crisis. People who bought Florida homes have equity. They put real money down, they have good credit, they're not subprime borrowers. But they can't afford to stay. Not at these insurance rates, not at these tax rates, not with the climate risk. They have equity, but they're forced sellers. And forced sellers with equity means one thing: motivated deals. There's no federal bailout coming for insurance companies. The government isn't going to subsidize your $12,000 premium. This isn't a liquidity crisis that the Fed can print away. This is a permanent repricing based on physical reality. Climate change isn't temporary. Rising seas aren't a bubble. This is the market correcting to actual risk. Here's my timeline prediction, and I want you to screenshot this so you can check back in 12 months. Phase 1 is happening right now. Luxury and coastal properties are softening. Sellers are getting nervous. Price cuts are starting. Phase 2 hits in 6 to 12 months. That's when investors capitulate. When the Airbnb income doesn't cover the insurance and mortgage, they'll dump. Inventory will flood the market. Phase 3 is 12 to 24 months out. That's the broad market correction. I'm predicting 20 to 35% declines from peak prices. The bottom? 2026. I know that sounds dramatic. I know people will say I'm fear-mongering, but I just gave you the data. I gave you the mechanism. I showed you the 4 horsemen. You can ignore it, or you can prepare for it. Look, I want to be clear about something. This isn't about celebrating people's losses. Real families are going to get hurt by this. People who made decisions based on incomplete information are going to lose money they couldn't afford to lose. That's tragic, and it's also inevitable. But here's the reality. Every market crash creates a new generation of wealthy people. 2008 created millionaires. The COVID crash created millionaires. This will too. The question is whether you're going to be one of them. In part 2, I'm going to show you 5 specific strategies to profit from this crash. Ethically, legally, whether you have $5,000 or $500,000 to deploy. Strategy number 3 is exactly how I'm personally positioning for this. And strategy number 5 is something almost nobody is talking about, but it might be the highest return play of all. If you want to be on the right side of the biggest wealth transfer in Florida history, hit subscribe right now. Turn on notifications. Part 2 drops immediately after this. And drop a comment telling me, do you think Florida crashes, or am I completely wrong? I read every single one. Let's get rich while everyone else is panicking. Welcome back. Let's talk about making money. If you're watching this, you're already ahead. You saw part 1. You understand the mechanism. You know the crash is coming. Now we position. Here's what I need you to understand before we dive into strategies. Every market crash creates a new generation of wealthy people. That's not motivational garbage. That's historical fact. In 2008, while everyone was panicking, a small group of investors bought foreclosures for 30 cents on the dollar. They're now worth triple what they paid. Some of those people became billionaires. During the COVID crash in 2020, while everyone was scared, smart money bought. Those properties are up 40 to 60%. The Florida crash will be no different, except this time you have advance warning. You're not causing this crash. You didn't create the insurance crisis. You didn't build too many condos. You didn't ignore climate change. You're simply providing liquidity and solutions when the market needs them most. That's not predatory. That's capitalism. But let me be brutally honest. This requires three things: patience, capital, and risk tolerance. If you don't have at least two of those three, most of these strategies won't work for you. I'm not going to lie and say you can get rich with no money down. This is real wealth building, not a TikTok course. Let's talk about how distressed markets actually create wealth. The wealth transfer equation is simple. Desperate sellers plus patient capital equals asymmetric returns. When someone is forced to sell, they'll take less than market value, sometimes significantly less. That's not because they're stupid. It's because they have no choice. Maybe they can't afford the $15,000 insurance premium. Maybe they're getting divorced. Maybe they lost their job and can't cover the mortgage. Their desperation is your opportunity. In a normal market, you compete with 10 other buyers. Everyone's offering asking price or above. You have no leverage. In a distressed market, you might be the only buyer. You have all the leverage. You can offer 20 to 30% below comparable sales, and they'll take it because they're out of options. That discount is your margin of safety. That's where the wealth is created. Now, there are three main approaches to profiting from this. Direct property acquisition. You buy real estate, hold it, rent it, and sell it later for a profit. Debt positioning. You buy mortgage notes, tax liens, or become a private lender. Or indirect plays. You invest in stocks, REITs, or service companies that benefit from the crash. I'm going to give you 5 specific strategies across all three approaches, from lowest capital required to highest, from lowest risk to highest return. Let's start. Strategy number 1, the distressed buyer play. This is the most straightforward. You buy property at a significant discount during the crash. But you need to start preparing now, today, not when the crash is in full swing. Build your war chest. You need 12 to 18 months of dry powder, cash, or liquid assets you can deploy immediately. Because here's what happens. When the crash accelerates, banks get nervous. Lending standards tighten. Even if you have good credit, getting a mortgage becomes harder. The buyers who win are the ones with cash or pre-approved financing locked in before the panic. Target markets matter. You don't want coastal properties that might be underwater in 20 years. You don't want luxury condos with $800 HOA fees. You want overbuilt areas with strong fundamentals. Tampa suburbs, Jacksonville, Port St. Lucie, areas that got overheated but still have job growth and population. And here's the key. Look for properties with assumable low-rate mortgages. Someone bought in 2021 with a 3% mortgage. They can't afford the insurance anymore. They need to sell. You assume their mortgage, put down the difference, and suddenly you're financing at 3% while everyone else is at 7%. That's a massive advantage. The numbers work like this. You buy at 25 to 30% below peak pricing. You rent it immediately to cover costs. You hold for 3 to 5 years. When the market recovers, you refinance or sell. Your return, conservatively, 50 to 80% over 5 years. Best case, you double your money. Required capital, $50,000 to $150,000 including reserves. Risk level, moderate. You're a landlord in a distressed market. Tenants might be harder to find. Property values could drop further short term. But if you bought right, you have cushion. Strategy number 2, the insurance arbitrage. This one's clever. Not many people are thinking about this. You specifically target properties being sold because of insurance costs. The seller is panicking. They just got quoted $12,000 a year. They can't afford it. They're listing. You negotiate seller-paid insurance for 2 to 3 years as part of the purchase agreement. They pay the premium up front, or they escrow it. You take over a property with insurance already handled. By the time that runs out, either the insurance market stabilizes or you've built enough equity to absorb the cost. Target inland properties, avoid flood zones, look for concrete block construction, newer roofs, hurricane shutters, anything that reduces insurance risk. And here's the advanced move: partner with insurance restoration companies. These companies repair properties after hurricanes. They see distressed deals before they hit the market. Owners who can't afford repairs, owners who are giving up. You create a referral relationship, they send you deals, you close fast, everyone wins. Required capital, $30,000 to $100,000. Risk level, lower than strategy 1. You've mitigated the insurance problem, which is the main cost driver. Strategy number 3, the note buying strategy. This is how I'm personally positioning. When homeowners default, banks don't want the property. They want the debt off their books. They'll sell the mortgage note at a discount. You buy a note for 60 cents on the dollar. The borrower owes $200,000. You pay $120,000 for the note. Now you have options. You can work out a modification with the borrower, reduce their payment, extend the term, help them stay in the house. You're still making money because you bought the note cheap. Or they default completely and you foreclose. Now you own the property for $120,000. It's worth $200,000, even in a down market. The beauty of this strategy, you're not competing with retail buyers. You're buying from banks and hedge funds who want liquidity. And you can start small. There are note marketplaces where you can buy pieces of notes for as little as $5,000. Required capital, $5,000 to $50,000 to start. Scale from there. Risk level, moderate to high. You need to understand foreclosure law. You need to vet the properties. You might end up owning a property you don't want, but the returns are exceptional. Experienced note buyers target 30 to 50% annual returns. Strategy number 4, the tax lien certificate play. When property owners don't pay taxes, the county sells tax lien certificates to investors. You pay the back taxes. In return, you get a certificate that earns interest. In Florida, that's up to 18% annually. The owner has 2 years to pay you back with interest. If they don't, you can foreclose and take the property. Most of the time they pay. You just made 18% risk-free, backed by real estate. Sometimes they don't pay. You get a property for pennies on the dollar. I know investors who bought properties worth $150,000 for $12,000 in back taxes. The catch: tax lien auctions are competitive. You need to know what you're doing. You need to research properties beforehand. You need to understand redemption periods and foreclosure processes. But if you put in the work, this is one of the highest return, lowest risk strategies available. Required capital, $2,000 to $20,000 per certificate. Risk level, low to moderate if you do your homework. Strategy number 5, the indirect beneficiary play. Maybe you don't want to own property. Maybe you don't want the hassle. You can still profit. When the market crashes, certain companies make a fortune. Foreclosure cleanup companies, property management firms, discount brokerages, home warranty companies, moving companies. Find the publicly traded ones. Buy their stock at the bottom. Or invest in REITs that specialize in distressed assets. They'll be buying thousands of properties at wholesale. When the market recovers, so does their stock price. Or, here's the move nobody's talking about. Become a vendor to investors. Offer a service that distressed buyers need. Virtual assistant services for landlords, property inspection services, title research, renovation project management. You don't need capital, you need skills and hustle. The investors making millions on real estate will need help. Be the help. Charge premium rates because you're solving expensive problems. I know a guy who started a junk removal company in 2009 focused on foreclosures. He's now worth 8 figures. Required capital, 0 to 10,000. Risk level, low. You're trading time and skill, not capital. Now let's talk about timing. You don't deploy everything at once. You don't try to catch a falling knife. You wait for phase 2, when investors start capitulating, when inventory spikes, when the panic is real. That's 6 to 12 months from now. Between now and then, you prepare. You save, you get pre-approved, you research markets, you build relationships with agents, lenders, note brokers, and tax lien auctioneers. You become ready to move fast when the opportunity appears. Because here's what happens. The crash will feel scary. The news will be terrible. Your family will think you're crazy for buying. That's exactly when you buy. When everyone else is fearful, you're greedy. Let me give you the action plan. Step 1. Pick your strategy based on your capital and risk tolerance. Step 2. Spend the next 6 months learning everything about that strategy. Read books, take courses, talk to people who've done it. Step 3. Build your team. Find a real estate agent who specializes in distressed properties. Find a real estate attorney. Find a property inspector you trust. Step 4. Set up alerts. Zillow, Redfin, MLS Access if you can get it. Track inventory, track days on market, track price reductions.